Balance sheet analysis. How to create balance sheet for a small company. Suppose your company requires 1 lakh rupees of loan. So you go for financing. Here you are raising this for long term. So long term funds are more costlier than short term funds. So let me analyze this in balance sheet. So liabilities and assets. These are the most important things in the balance sheet. First of all, let me analyze how these sources are came from. The first source is capital equity. By offering equity shares, they had raised 60,000 rupees. By offering preference shares, they raised 20,000. By offering long-term loan, they raised 10,000 rupees. And remaining short-term loans, they are raised 10,000. So now the assets. Here they are by using these sources how they are allocated into assets. So the first of all here capital equity, preference shares and long term loan. These three are for the long term. So these long term sources are more costlier. So all these sources should be allocated into the long term assets only because they should generate more returns than the long term cost. Okay. First of all fixed assets. The 50,000 is allocated from the capital equity. In this section, they are allocated 50,000 for fixed assets. And the investment of 40,000 is allocated by using preference shares, long-term loan and capital equity. Here it is 40,000. So here are the long-term investments. These two investments should generate more revenue than this cost. And here the short-term loan and current assets. This short-term funding should go for short-term assets. This for this current assets, this should not include the long-term loans because these short-term assets they can't produce more returns. Finally, we can say that these funds are raised and allocated efficiently in this balance sheet. I hope you people understood. Thank you.